Welcome to the deep dive. Sometimes in global finance, it's not the huge, obvious waves that tell the story. It's the small tremors, the seemingly routine events that suddenly, well, they crack open the surface and show you the fault lines underneath.
And we definitely got one of those tremors on September 17th, 2025. That's when the U.S. Federal Reserve announced a rate cut, just a quarter point.
Right, lowering the federal funds rate target to between 4 and 4.25%.
Exactly. On the surface, maybe it sounds like standard central banking, right?
Yeah, if you just glanced at the headlines, you'd probably file it away. But the research we've dug into for this deep dive, the market bulletins, economic analysis, it paints a very different picture.
hmm That cut is signaling something much, much deeper. It suggests the confidence, the very foundation of the dollar's global dominance, is facing serious questions.
And at the same time, gold is making a comeback. Quietly, but, well, unmistakably, it's regaining its status as that trusted neutral store of value.
So our mission today is really to step back from the day-to-day noise. We want to synthesize the evidence for you. We're looking at the monetary, the fiscal, and the geopolitical forces that are pushing central banks, big institutions, and, yeah, even individuals towards physical assets.
We want you to understand why this shift seems to be picking up speed and what it could mean for, well, the future of money itself.
Okay, so let's start where that tremor began, the feeling that U.S. monetary policy is getting politicized.
Right. The Fed had been tightening for a long time, trying to get inflation under control. It was a steady course. So why did this one cut send such ripples?
Because it broke the pattern. And perception is absolutely critical here. Central bank independence, that's supposed to be the cornerstone of credibility.
The idea that they make decisions based purely on economics, not politics.
Exactly. And the sources we looked at, they're really concerned. There's this growing perception, or maybe suspicion, that the September cut wasn't just about the economic data, unemployment, inflation numbers. It's seen as being influenced by, well, the political climate.
Which immediately makes people question impartiality. And look, we have to be careful here, just report what the sources are saying impartially. The research clearly points out this timing the policy shift towards easing rates happened right alongside pretty significant political pressure.
That's the key connection they're making.
Mm-hmm.
Specifically, President Donald Trump had been very public, very consistent, calling for rate cuts. And that coincided with some newer appointments to the Fed's board.
So the concern isn't just the tweets or the public statements. It's about who is actually sitting at the table making the decisions.
Precisely. It's about whether those appointments might fundamentally alter the voting calculus inside the Federal Open Market Committee. Does the bias shift away from being this purely objective guardian of stability towards something that seems more responsive to, the immediate political wins?
And when the market gets a whiff of that the Guardian might be compromised, politically speaking, trust just evaporates, it happens fast. How did we see that play out immediately after the cut in September?
Well, it was pretty clear. Stocks, well, they didn't exactly rally hard. Gains were subdued, suggesting investors were cautious, maybe skeptical. Bond yields went a bit haywire, fluctuating quite a bit. That signals uncertainty about where inflation and debt are heading long term.
But the big one, the dollar.
Yeah, the dollar weakened almost immediately against other major currencies. That's often a direct reflection of fading confidence. Confidence in the U.S. government's ability to manage its currency without political interference. It seems like in this case, those political worries started to outweigh the pure economic numbers.
Okay, so that lack of perceived impartiality in the U.S., that feels like the perfect lead-in to why other countries are reacting the way they are. I mean, if the stability of the world's reserve currency now feels tied to unpredictable politics in Washington, why would you keep all your eggs in that one basket?
You wouldn't, or at least you'd start looking for other baskets, maybe some safer ones. And this is where the whole geopolitical picture becomes really crucial.
The source materials really emphasize how strategic events recently, particularly the massive financial sanctions on Russia after the Ukraine invasion. That was like a global wake-up call, wasn't it?
Absolutely. It was a stark demonstration of financial power, and it fundamentally changed how nations think about risk. Suddenly, holding huge reserves in U.S. dollars meant those assets could potentially be frozen or restricted based on U.S. political decisions.
Reserves that are supposed to be your country's sovereign wealth, your safety net.
Exactly. They were effectively shown to be potentially weaponizable.
Mm-hmm.
And that realization created this immediate, almost existential need for other countries to diversify their holdings.
And it wasn't just a theoretical discussion. The research shows this diversification kicked into high gear, right? Central banks acted fast.
Exponentially faster.
Hmm.
They're actively trying to de-risk their national balance sheets. And it's happening all over the globe. Look at the specifics the research lays out. Emerging economies, especially big players like China and India, they've been very deliberately, very significantly increasing their official gold holdings.
Why gold specifically?
Well, they see it as a hedge. A hedge against the dollar possibly losing value, yes, but also against that geopolitical risk, the fear that their dollar assets could be impacted by sanctions or some future conflict.
So we're not just talking about a short-term market adjustment. This sounds more like a fundamental, a structural shift in the global financial system.
I think that's exactly right. It signals a gradual, maybe slow, but very intentional move away from the purely dollar-centric system we've had since, well, since Bretton Woods, really. We're edging towards a more multipolar world, financially speaking.
And in that kind of shifting world, gold plays a unique role.
A critical one, because it's seen as reliable and, crucially, non-sovereign. It doesn't belong to any single country's political system. No one government can just decide to freeze your gold reserves held domestically or devalue it overnight by printing more gold. It stands apart.
That idea of gold as the neutral, non-sovereign asset, that takes us right into the weirdness of its recent market behavior. Section 3 in our notes. Because normally, gold doesn't pay interest, right? So when real interest rates are high, meaning government bonds are paying you more than inflation is eating away, gold should look less attractive.
That's the classic textbook theory. The opportunity cost is high. Why hold gold that yields nothing when you can get a safe, guaranteed return elsewhere?
But that's not what happened in 2025, is it?
Not at all. And this is the really surprising fact the research highlights. Gold's price has actually climbed quite a bit through 2025, even with those higher real interest rates. It's bucking that traditional logic completely.
And not just climbed, it hit new records. The sources confirm it broke through $3,600 an ounce recently. That suggests a real change in thinking.
It does. It implies that investors, and maybe central banks even more so, are looking at gold differently now. It's less about just hedging inflation, though it still does that, and much more about being a trust barometer.
A trust barometer, explain that.
Well, when confidence in government promises starts to fade promises about managing debt, about keeping central banks independent, about the long-term value of fiat currency, that skepticism needs an outlet. And gold becomes the place where that lack of trust shows up. Its price reflects a judgment on the credibility of sovereign powers.
Wow, okay, so the price isn't just about yield or inflation anymore, it's about risk. Political risk, fiscal risk.
Exactly. The sources connect the dots like this. We're worried the Fed isn't truly independent anymore, Section 1, and we're worried governments might weaponize currencies or default via inflation, Section 2. In that environment, gold becomes the ultimate insurance policy against a breakdown of trust in the system itself.
And if this is a structural shift in trust, not just a temporary blip, what are the forecasts looking like?
Well, some major players are definitely seeing it this way. JP Morgan, for example, is cited as forecasting continued upward momentum for gold into 2026. And importantly, their reasoning isn't based on some short-term trade. It's anchored in these persistent structural issues, ongoing geopolitical tensions, and maybe most importantly, those widening fiscal deficits in major economies, especially the U.S.
Okay, that brings us perfectly to Section 4, the underlying fiscal situation in the U.S. We've hit the Fed's perceived politics. Now let's talk about the government's own balance sheet.
Yeah, the sources are pretty blunt here. The U.S. is facing huge ongoing fiscal deficits and a national debt that just keeps climbing. And that backdrop, that constant need for the government to borrow more and more money, is what really eats away at long-term trust in sovereign creditworthiness.
Meaning faith that the government can actually pay back its debts without resorting to, say, printing tons of money and devaluing the currency, or imposing crippling taxes down the line.
Correct. And there's an interesting contrast the research points out. Over the last few years, many big corporations have actually cleaned up their balance sheets, paid down debt, become more resilient. But at the same time, government borrowing has gone in the opposite direction. It's accelerating. So this loss of confidence feels very much like a government-driven issue, not a private sector one this time.
Which maybe makes the distrust feel even more pointed. If the private sector is getting its house in order, why isn't the government?
And that widening gap, that fiscal imbalance, is directly fueling a move towards physical things. We're seeing a documented surge in actual physical gold demand. It's coming from individual retail investors buying coins and bars, but also from the official sector, those central banks we talked about. People want stuff they can touch.
It makes intuitive sense, right? If you're worried about paper promises, you want an asset that can't be easily frozen, confiscated, or inflated away by political decisions.
Precisely. And this isn't just about stacking gold bars in vaults. This preference for tangible, neutral assets is starting to potentially reshape how global trade itself works.
How so? The research mentioned something about commodities pricing.
Yeah, this is potentially a huge deal for the dollar long term. There are increasingly serious discussions, even proposals, about pricing critical commodities, think oil, natural gas, not just in dollars, but perhaps in units linked to the value of gold.
Wow, that would directly challenge the petrodollar system.
It would chip away at it, certainly. The logic is, if you're a major energy producer, why price your most vital export in a currency that could be subject to sanctions or political whims? Pricing it relative to gold, a neutral asset, starts to look appealing. It's a slow shift, but the conversations are happening.
So gold is leading the charge here as the main monetary haven. What about silver? Does it follow suit?
The sources do mention silver. It's generally seen as following gold's lead in this trend of monetary distrust, though it's more volatile. Silver has that dual role, partly monetary, partly industrial, which adds complexity. But the underlying driver, that move towards tangible assets because of skepticism about fiat currencies, that applies to silver too. Maybe think of it as gold's more jumpy cousin.
This has been really illuminating, connecting all these dots. Let's try to quickly recap the key drivers for you, the listener. It seems this potential transition, this questioning of dollar dominance, boils down to maybe four big things working together. First, the Fed appearing more vulnerable to politics, which damages trust.
Second, central banks reacting to geopolitical risks by actively diversifying into gold because it's non-sovereign.
Third, the really deep underlying problem of U.S. fiscal deficits and mounting debt, eroding confidence at the source.
And finally, gold itself stepping up, acting less like a commodity and more like that global trust barometer we talked about. Its price reflects the system's stress level.
Right. And the takeaway isn't that the dollar is collapsing tomorrow, but that the structure is shifting.
Definitely. The dollar is still dominant today, no question. But the foundations are undeniably moving. We're seeing clear steps towards more diversification, more reliance on tangible assets like gold. It really does look like the early stages of a more multipolar monetary system taking shape.
So, as we wrap up this deep dive, we want to leave you with a final thought, something to mull over, building on that idea of fiscal health. We focused a lot on the U.S. situation, but this issue of government debt isn't unique, it's global. So, the question for you is, how might the trajectory of deficits and debt in your own country or globally affect the long-term credibility of your government's promises and ultimately the value and stability of your own currency?
That question of sustainable public finances really is one of the central economic challenges for everyone, everywhere, in the years ahead. Thank you for joining us for this deep dive.